Hey, my friend Stephen Brooks here, and I teach traders who have $25,000 or more in their trading accounts how to generate a very reliable salary, trading as much as 2 hours a day, as little as 5 minutes a week. Plus, we use an AI automated trading bot that does a lot of the heavy lifting for us. Now, sometimes I get asked the question, why are you so high on trading? Why are you so high? Why do you think it's so important to talk about and speak about financial markets? The reason why I have chosen financial markets over other things like crypto or real estate or credit or other types of investments is because I am of the belief, now I've done it myself and I've also taught a lot of people to do it, that there's no better place to get there's no higher cash on cash ROI situation than you can get from trading in the market. Now, again, it doesn't have to mean that you're sitting there all day, every day, right? It could be 2 to 3 hours a day. It could be 5 minutes a week. There's a lot of automation now, especially in 2024 and beyond. There's a lot of things that can be fully automated. So that's really very little time. But in my opinion, and I'll link in the description to this video, I did shoot a video a couple weeks ago about my experience between trading in the market versus real estate, why I think that trading in the market is a much better vehicle to be able to get a very high cash on cash return on investment return each year. And the reason I'm such a big proponent and the reason I like to talk so much about growing wealth, growing money is because leaving money in a bank is a death sentence for your money. And further, if you were able to learn to be able to acquire the life skill of, let's say, getting a 20, 25, 50, 100% cash on cash return on your money each year via trading, some of the things that are probably going on in your current life today, like feeling the impact of inflation, would be much smaller of an impact. And what I really want to talk about today on this channel, we give a lot of trading education. We teach a lot about trading. We teach about individual trades. We teach about the psychology and some of the mental things behind the scenes when it comes to trading. But ultimately, I'm going to show you why it's way more important than you probably ever thought to learn the skill. If you don't learn it, to learn it. And if you do understand the skill, but are really not getting the outcomes that you're looking for, to double and triple down on your efforts to be able to really get the skill. Because one of the nice things is, manufacturing changes every couple of years. Marketing changes every couple of months. NFTs were a huge thing back in 2021, and then you don't even hear about them anymore. Yeah, crypto's back, but it was in a quote-unquote winter for a couple of years. Things about construction change. Things about the workforce change very frequently. But a lot of the trading methodologies that I use, that we teach our students, they're really here to stay, which is why I feel like learning this skill, and once you learn it, you could really be self-sufficient for yourself and your family for the rest of your life. And the reason why I say that is because the debasement of dollars is dramatically greater than you probably ever imagined. So today is March 21st, 2024. Yesterday, we got a CPI reading. Now, I'm looking down here on my screen right now because I want to give you accurate numbers. The CPI number that we got, or no, we didn't get CPI yesterday. We got a FOMC, a Federal Open Market Committee, a Fed announcement. And the Fed said that they were going to stick with 3 rate cuts for the remainder of the year. Stock market's at all-time high. Clearly, Jerome Powell got the tap on his shoulder from his boss, aka the president, saying, hey, we got to juice this sucker going into the election. But again, this comes back to why you need to understand the skill. The reason you need to understand the skill is you are being told that consumer price inflation is up somewhere between 3 to 3.5% year over year. So last year, March of 2023, prices that impact consumers are quote unquote only up somewhere between 3.5%. So if you didn't make a return on your money of more than that, 3 to 3.5%, you actually lost money. Now, the money didn't go negative if it's in your bank account, but you lost the ability to purchase the same goods, services, the things that you buy than you did last year by about 3 to 3.5%. That is what they tell you. That is a lie. That is a really impressive lie. And the fact that people buy into that, that's a whole nother conversation. So you think you needed a 3 to 3.5% return on your money last year to be able to beat inflation. You actually needed a 17% return on your money last year to beat inflation. And as of right now, CPI is not up 3 to 3.5%. It's up 8% right now. How do I know? Well, I'm going to show a graphic on the screen right now. Where am I in the video so I can... Okay, good. I'm going to show a graphic on the screen right now. And what you're seeing on the screen right now, in the blue line, is the official CPI number. So the government or whatever agency is responsible for coming up with this number, the blue line is the number that they have told the citizens, the number that they communicate publicly in terms of CPI. What you'll notice is in the 70s, if you were around back in the 70s, it was nasty. So 74, 75, we had a big spike up to 12%. Then it came down to like 4 and change, maybe 5%. Then in like 1979, it went parabolic all the way to 1982, where it went up to about 15%. And then really since 1982, it's gone lower and it hasn't really spiked up until beginning in January of 2021. Now, what you'll notice looking at this chart right here is that the official number that was given to us by the government or by whatever agency is responsible for coming up with this number and publicly communicating it, it topped out about 8%. But you'll notice the yellow line here. The yellow line here is the formula that was used to produce the blue line before 1983. Right, so before 1983, we in the second half of the 70s, and then in the later half of the 70s, early part of the 80s, we had two very large spikes in inflation. Once inflation really got down to those pre-levels in 1983, they changed the way they formulate CPI. And what you'll notice is the blue line, again, is what they've been saying the whole time. And then the yellow line is using the exact same formula that was used pre-1983. So what you'll notice is from 1984 till 2021, the yellow line either was overshooting by maybe 10 to 20%, the number that they actually gave us, and it was also undershooting from times, maybe about 10 to 20%. But realistically, I think you could say they were pretty close, right? The delta between the CPI number that they were giving us from 1984 until 2021 was really relatively accurate using the CPI formula that was used before 1984, plus or minus 10%, right? You can see in the great financial crisis, they said in CPI was like negative 1.5%. It was really negative 4. In like right around 1999, they said CPI was around 4%. It was really like 5%. 2016, they said inflation was like 2%. It was really like 3%, maybe a little bit more. So it was the delta between those was not egregious until 2022. And you might be saying, well, what is the difference between the yellow line, which is, again, the way that inflation was calculated before 1983, and the blue line, which is what they tell us right now? There's 3 things, and I actually wrote them down here. So if I'm not maintaining eye contact, that's because I have notes right here. So there were 3 things that massively changed. And what you'll notice is when I give you the dates of when these things changed, what you're going to see is a greater delta overall as these changes took place. So there are three changes. One of them happened in 1983, another happened in 1999, and another happened in 2003. So again, what you'll notice is if you kind of take a look at this chart right here, and if you draw a vertical line on 1983 to 1998, they were pretty close. But then the delta started getting a little bit bigger in 1998. And then since 2003, actually, it's really since that's wrong. I can't read my own handwriting. Since 2009, the number has gotten even more egregious. And then again, the biggest egregious number right now is what we've seen right now, because they said CPI peaked at 8. It was really 17, maybe 18%. They say CPI right now is between 3.5%. It's really 8% right now. So what were those three things? And then how will this relate to you? Well, the first thing is, in 1983, right? In 1983, whoever comes up with the CPI number started removing borrowing costs in the form of mortgages from Consumer Price Index. Do you own a home? Do you pay a mortgage? That mortgage expense, as of 1983, is no longer calculated in CPI. Yikes. That's not good. So by just removing mortgage interest from 1983 and then not changing the formula until 1998, again, close. But the delta between the two, relatively close. In 1998, what was removed from the CPI number was car loan payments. And what you'll notice is, from 1998 till 2009, the number started to get, the delta between reality and the actual number started getting a little bit bigger. Then in 2009, what was changed, not removed, but what was changed was the way they factored healthcare went from a 50-50 split between premiums and out-of-pocket expenses to a 95-5 split, with 95% of the weight coming from healthcare costs being related to out-of-pocket expenses and only 5% being weighted to healthcare premiums. So Visa removing mortgages, which how many tens of millions of Americans pay every single month? By removing car payment loans, which how many tens of millions of Americans pay each and every month, and by having a much smaller weight, 1/10 of the previous weight of the healthcare costs being reduced from the actual premiums, which for me went up 20% last year, to just out-of-pocket expenses, and I don't even know what they are. For me, to be honest, that's how you come up with a number that looks a lot better than it is. So again, inflation peaked around 17-18% in 2022. It's come down to about 8 right now. The official number says it peaked around 8 and it's come down to 3.5, whatever it is, but it's still hot garbage. And what I would say to everyone is the people who are responsible for coming up with this number, it is unlikely that they're all of a sudden going to revert to a more accurate representation of inflation. And it is much more likely, if history repeats itself in the future, it is much more likely that they will continue to do things to make the numbers look not as bad as they are, to make the numbers look rosier than they are. And since that is the case, you do have to make a lot more of a conscious effort, whether you've never invested before, whether you've never traded before, whether you're someone who's tried but really has only really given it the old college try. You, from now on, are going to have to do probably better every single year in terms of a cash-on-cash return of like 7 to 8%. The way the government is going into massive deficits to try to create growth is leading us down a path where our baseline inflation is probably going to be somewhere between 7 and 8%, regardless of the numbers that are given to you, right? So maybe at the end of the year, they'll say inflation has gone under 3%. It'll still be around 7%. And if they do start cutting rates this year, again, whatever the official number is, you can multiply that by 2 or 3, and that's kind of the barrier you need to get over. So again, if you're somebody who has just kept your money in the bank because, look, it's been a little bit of a challenging year for the last couple of years for people, I get it. You're going to need to learn a skill to be able to do better than that. If you're somebody who maybe is not getting the results you want in terms of your investing, you're going to need to double down on your education, because if you, from now on, I would argue, if you're not having a cash on cash return on your money of at least 7%, you are going to be losing purchasing power on everything that you own. And it's unfortunate that so many people are being misled at such an egregious level, but this is the case. So again, 1983, they removed mortgages from CPI. 1998, they removed car loan payments from CPI. 2009, they reduced the 50% share of healthcare costs that was attributed to premiums to 5%. Those things are still happening to me and you. Those things are still happening to you and I, yet they're not reflected in CPI. So where you think if you make 3% on your money this year and it lines up with CPI, don't kid yourself. You got to do better than 7 to 8% a year. And again, I teach people, a lot of the people that I teach make 1% a week, 0.5% per week. We have a lot of people that double or triple their account in a year. It's totally true. And we have the statements to be able to back that up as well. If that's something that is interesting to you, go ahead, watch a bunch of videos on this channel. We have a program called Inner Circle where the average member makes $4,000 a week. The average person in that program has $50,000 in their account. So it's not like these people have millions and millions and millions of dollars to be able to do this. But they've learned the skill and they understand the skill and they've mastered the skill of being able to grow their money at a rate that is substantially higher than the real CPI, which right now is about 2.5 to 3 times greater than what they're actually telling us. I'll place a link below this video for those folks interested in coming on board with that program. It's a really good program. We just get fantastic results. If you're not, no big deal. Go ahead, like this video, share it with a friend. Go ahead and subscribe, hit the bell so you can be notified for every other video that I post. But at the end of the day, if you just take the number that they give you with CPI and multiply it by 3, that is your barrier. Right? That is the hurdle you need to overcome every single year on your money. And sure, it can come from asset appreciation, but I like a cash on cash return. Because for me, with the way I do it, asset appreciation is pretty much understood as it's going to happen. And that's all I got to say about that. So again, it's never been more important than now to learn the skill to be able to outpace inflation. Recognize that your barrier to outpace inflation is 2 to 3 times greater than they will tell you it is. But if you take ownership in that and you put in the work, you can not only outpace inflation, but if you really learn the skill to be able to generate $1, $2, $3, $4, $5,000 a week from trading, that will make inflation something that becomes irrelevant to you. That will make monetary debasement something that becomes irrelevant to you, and that will give you true financial freedom. I'll see you in the next video.